Good morning, folks. So today I'm going to be doing a weekly wrap covering about these 7 broad points. Going to be speaking about the Monetary Policy Committee's meeting today and what they decided, the rare earth crisis that is now gripping the world. Going to speak about corporate bond flows. We're going to speak about retirement planning trends, and let me tell you, that doesn't look very good. So Q4 results and trends, health insurance, and crypto. So let's get on. So the newspapers have been carrying this article about how China has stopped exporting rare earths, and these rare earths are critical to make magnets that go into motors, and these motors are the critical part of all electric vehicles, right? And it so happens that China has the largest processing capacity for these rare earths globally. It is not the largest miner or producer of the raw rare earth, but it is having the largest processing capacity. So the largest mines are elsewhere. I mean, China has large mines. Apart from China, Australia, the US, and some South American countries all have very large mining capabilities, but they don't have the refining capabilities that China has built up. And now China is going to be using this as a leverage. With the kind of demand that electric vehicles has, and the way most global automobile companies have focused on producing more and more EVs, because that is the trend of the future and that is where demand is happening. This comes as a big shocker, because almost every automobile company in the world is dependent on Chinese magnet exports to put into their EVs. It also has application for in defense and aircraft manufacture, aero engines, etc. So it has created a lot of confusion and a lot of fear. What Indian automobile companies have said, the likes of Tata Motors or Bajaj Auto or the Mahindras, Ola, etc., depending on which company it is, between June and July, they will have no more magnets to produce new EVs. Now, does that look like a crisis to you or not? To me, it looks like a big crisis. Okay. Till the Indian government is able to negotiate and bring this down. So strangely, the only country or the only company that has received a quick clearance for importing magnet from China is Volkswagen of Germany. So the process that China has said will be there is that anybody wishing to buy magnets from China has to apply to the Chinese government, and those applications will be reviewed carefully, and then only will allotments be made. Ostensibly, they do not want these magnets to be misused. Okay, read used in defense areas. Okay. So I think possibly Volkswagen has been able to get this more easily than the others, because China is looking at a bitter relationship with Europe. They want to have Europe as a large trading partner. Given the kind of tensions that are there between US and the rest of the world, China is wanting to come in and leverage this chaos into building stronger partnerships with the rest of the world. Now, I don't think that India can expect any favorable treatment from China in this regard, given the kind of proxy war complexity that we have between China, Pakistan, and India, and each firing from the others. So Pakistan and China firing from each other's shoulders with India as a target. I do think there's a problem here, and overall, the kind of conflict situations that are building up in different areas and different parts of the world are to be taken note of. And I think it will be right to be concerned, whether it is war or trade or immigration. I think we are looking at a far more multipolarized world, and I think diplomacy has been given a firm handshake goodbye. And we are only going to be seeing hard, selfish negotiations happening between countries. That does not bode well, if you ask me, but we have to live with this and go through this. Okay, and today we had the Reserve Bank of India's Monetary Policy Committee meeting to decide on the interest rate stance. So though it is just the interest rate, it has implications on growth, on liquidity, etc. So surprisingly, the RBI cut interest rates by 0.5% today. The market did not expect more than 0.25%, and then saying that we'll have a soft outlook, what they call a dovish outlook, and do some later on during the year. But the RBI came and upfronted with a 0.5% cut. So now the repo stands at 5.5% per annum, which was 6% earlier. And to ensure that this 5.5% is transmitted down the line to the banks who are actually lending the money to corporates and retail borrowers, the RBI has promised sufficient liquidity. Okay, so surprise, it has gone ahead and said the CRR would be coming down by 100 basis points. That is a 1% cut in CRR. So what it means, my friends, is that when the CRR is cut, that much more money is available in the banks to on-lend rather than give to the RBI for safekeeping as a reserve. So this releases a large amount of money, and liquidity in the system will be higher by the time we reach September. So when liquidity is higher, you are going to see transmission of RBI policy much quicker. So these softer interest rates will transmit to the end borrower much more easily if there's sufficient liquidity. And that is what the RBI is making happen. The shocker is this. While it has cut interest rates more than expected, provided more than enough liquidity, it has said that their stance, which was accommodative, has now moved to neutral. So just the previous policy, the RBI had moved to an accommodative stance. Okay, and from accommodative, it has moved one notch higher to neutral, which means that the market cannot expect more interest rate cuts as easily. It cannot expect more liquidity as easily as it has provided in the last few months. So we could be at the end of the interest rate cycle unless new data comes up which demands that the RBI cut rates further. But going by the inflation projection at 3.7% and the interest rate 5.5 now, maybe a little more, it could come down depending on how inflation is growing. Folks, it looks like there's no more juice left in the long bond market for now. Okay, but this is good for growth. When interest rates are lower, it's a great leg up for growth, and the equity markets have responded by going up 1% today after the announcement by the MPC. The bond markets, I'm waiting to see how they react. They could be disappointed, saying that there's not much more room for capital appreciation, not much more room for interest rates to come down more. Let's see what the bond market does in the coming week. Today was a knee-jerk reaction, but they would have probably absorbed this news and then see what happens. So there's another headline in today's paper. It says corporate bond buying by FPIs at a 10-year high. It means that FPIs have bought so much corporate bonds now that it's at a 10-year high. This has largely happened because of one single deal. The Shapoorji Pallonji Group had gone ahead and raised $3.35 billion from foreign institutions. And hold your breath, the rate on this bonds that they have raised is 19.75% per annum. It's a medium-term bond. That is a very high rate of interest. AAA corporates in India are able to borrow at hardly 1% above the about GSEC. So they're borrowing at 7.25% very happily. And here comes Shapoorji Pallonji, which obviously is not a AAA, but a well-known brand in that sense, ranges 19.75. So let's take a step back and see what's happening. Over the last few weeks, we have seen the yields on US government bonds move up sharply. On the 30-year bond crossed 5% and then stabilized later. but the 10-year bond is at almost 4.5%, 4.43% or so currently. And this is much higher than what it has been in the recent past. Whereas Indian government bonds, which were at a higher yield, have been steadily coming down to now 6.23% only. The gap between what one can earn from a US government bond and an Indian government bond is reduced much to a kind of a low that we haven't seen in many decades. What it means is the attraction in buying an Indian government bond is no longer as great as it was, because they are getting a similar rate of return from a US government treasury, from a US treasury bond. So you see, this has implications that, as thought earlier, we thought foreigners would be buying a lot more government bonds, a lot more corporate bonds. That expectation, I think, has to be moderated. But given the weakening dollar, you may actually see many of these foreign bond investors coming forward looking for high yield emerging market bonds, okay, where they can make a far higher rate of return, though the risk is higher, okay, rather than buying sovereign debt or AAA debt. It's going to change a lot. There have been so many developments over the last few days in the bond markets in the West, whether it is US and on the other end it has been Japan. Two large borrowers have seen yields on their bonds shooting up. Okay. Now Japan, which had close to a 0% rate of interest for so many years, now is having a yield of almost a 3% on the Japanese 10-year bond. Okay. What does this mean? It means that Japanese investors will get a decent rate of return in their local currency, in their local government bonds, rather than going and having to invest in other countries, the largest portion of which was invested in US government treasuries. So you may not see the kind of outflow of yen to the dollar as was happening earlier, and in fact you may even see some return of the yen. Treasury investors selling US treasury bonds and coming back to Japanese yen bonds. You please remember that the dollar weakening also will have a huge impact on this move. This is a structural change, believe me, and we are going to see the impact of this for quite a long while, and this is unfolding event. Let us see what happens as we go forward. Also, we see that silver has moved up considerably, almost 7.1% over the last 1 week. So we kept on talking about silver being undervalued as compared to gold, right? And suddenly in 1 week it has moved up 7%. Possibly the story about the deficit in supply is rearing its head up, though it was largely known. People keep looking for news to justify an action, and I think this is one such news where investors largely knew that there was about 200 million tons of deficit production in silver mining, and the demand is as much higher, so prices had to move up to make way for the short supply. That is what is happening. Then, as I promised, I would be talking about retirement trends. So Grant Thornton made a survey, the Grant Thornton Bharat survey of private sector workers aged between 25 and 54, and checked on their plans for retiring. Okay. The survey finds only 74% of all participants save just 1 to 15% of their monthly income for retirement. Pretty sad. Okay. And 53% of respondents expect a pension of over 1 lakh per month post-retirement. But what are they doing about it? They're not doing much about it. Okay. Only 11% believe their investments will be enough to meet that goal. And 42% are not at all confident their retirement needs will be met. So there's such a large gap between expectation and action. They all expect to get a lakh pension, but they're doing nothing about it. And as time passes, it becomes more and more difficult to build the corpus required to give you that annuity or a systematic withdrawal plan which is going to last you through all of retirement. I just think we don't have enough of financial awareness going around. We do not have enough of financial literacy and education going around. Because unless you start early on issues like retirement, you really cannot make it. You have to compromise on lifestyle. And who likes to compromise on lifestyle after retiring? But the fact is that today's youngsters are more happy spending rather than investing. And I really, really hope that people realize this and change. Because inflation is going to hit so hard, people are not going to realize what hit them. And before they understand, they've retired and they find that they don't have enough money in the bank or in the mutual fund portfolios to fund their retirement. We've been speaking about the Q4 results over the last couple of podcasts, and now all the results have come out and we have some firm figures. And clearly it shows that the Nifty EPS growth over the of FY25 versus FY24 only grew 7%. Okay, so that does not look good. Of course, this was the expectation that it would not look good, but still when it comes out, we wonder. So when we look at a 7% earnings growth and our price earning multiple on the Nifty as such as 20 or so, it does feel that markets are a tad expensive. Of course, markets always look forward. And if we had a 7% earnings growth last year, the belief is that the next year will at least see a higher rate of return, and the average of the next 2 years will at least be a early double-digit return of 12-13%, or somewhere around between 13 to 14% could be the earnings growth. Okay. So let us be watchful. Of course, this is a weighted average number of the index earnings, right? Though there are quite a few companies in between have kept up to expectation and even beat expectations. So an active fund manager obviously looking at these companies to buy into the portfolio. Let's just bear this in mind before coming to any conclusion about being in the equity market or out. It does say, the newspaper does say that continued headwinds in consumption meant subdued revenue growth. Post-COVID, profit recovery has been mainly led by margins rather than revenue. So we had almost all input prices falling, and these higher margins contributed to higher earnings. And if we look at the chart, it does look that many sectors are at the top of their margins, range of margins in history. And one would possibly think that there's no more scope to increase margins. And unless the top line increases, you will not have earnings increase. Okay? But in the midst of all this, we saw the inflation coming down to 3.7%. So the inputs that are required for consumption companies are coming down. Their prices are coming down. And we also saw that customs duty on imported edible oil being dropped by the government of India. It's a critical component in all the food companies, for all the food companies and biscuit companies and so on. So you probably will see their margins going up in the next couple of quarters. And if FMCG companies choose to retain this price advantage for some time, you will see higher gains. And given good monsoons, etc., you hope that rural consumption and urban consumption will pick up. There are a lot of doubts about urban consumption, and there is a headline here which also says age catches up with Infosys and TCS as automation enters the workforce. So we are seeing that these companies are hiring less youngsters. So the average age of these companies has actually gone up, whereas all these years the average age was coming down. And possibly these companies are not hiring as many college graduates because automation is doing much of the work. So this is a trend that we need to keep our finger on and see what happens. This is going to impact spending, it's going to impact demographics, a lot of issues. As we go into the newspaper, it's saying the great senior health cost dilemma: pay up or save up. It's about health insurance and how health insurance premiums have been shooting up over the last 3-4 years. And those who are impacted more are ones who are just going through the age slab, moving from one age segment to another age segment. And if you just cross the age segment bucket of 60, you suddenly find your premiums moving up. Okay, and may become unaffordable for some. So this is the biggest dilemma, and there have been many who figured that rather than pay premiums, they'll stop their insurance policy and try to create a fund. But this is a kind of a knee-jerk reaction, And it is better that one goes through a series of calculations to determine whether it is cheaper to pay premium or cheaper to stop and build a fund. Okay, and we do have some analysts who have reported here that they find that it is cheaper to pay the premiums even though they are expensive. Okay, and rather than stop the insurance policy altogether. Okay, there is a solution that you could have a lower base policy and have what is called a super top up policy. The super top up policy means that some of the cost is borne by the policy holder and the rest of the cost is borne by the insurance company. In such a case, the premiums drop dramatically. And for those who can do it, it's a great thing to do. Go for a low base policy, have a larger super top up, and reduce your premiums, increase your coverage. That would be a great thing. Okay. But at the same time, I would recommend that wherever possible, build an emergency medical fund. Just in case your claim does not get processed for God knows what reason. Okay. Do build up an emergency medical corpus and keep it. Never know what happens. Plan for the worst is my policy. Okay. And we have, you won't hear me talking much about crypto, but here I am going to be speaking about crypto today. Okay. There's a very interesting article by Srikanth. It says, stay alert. Crypto is turning into a geopolitical weapon. Okay. And here the views are radical, but I must say that I tend to agree with the author here. The direction and the trend in this. Much of this has been brought into attention by the deal that Trump's family members through their crypto venture have entered into with the Pakistani government, and they want to make Pakistan the crypto capital of the world. That's frightening to think of, because we all know that crypto cannot be tracked, and that is why you have a lot of illicit financing, terror financing, drug financing happening through crypto, because it cannot be traced, it cannot be tracked, and you're making one of the worst terrorist offending countries a crypto capital. I think I can see what is going to be happening with this. And who's going to be advising the Pakistani task force on this? It's the CEO of Binance, who himself was caught in a massive fraud case and fined $4.3 billion by the US government for his activities. He's going to be doing this. So you're going to see crypto being supported by superpowers like this and being used for the wrong purpose, the exact wrong purpose which everybody was worried about. So it's going to be very worrisome as to how crypto happens. We would like to see cryptocurrencies that are supported and regulated by central banks, not the ones like this which are privately funded and can be used for illegal purposes. I just hope that this gets corrected sooner than later. Okay. So during the week, we have not seen much movement in any of the markets. Just today, after the Monetary Policy Committee announced its 0.5% rate cut, Indian markets were very happy, and 1% jump in the Nifty, and the silver jump of 7%. Other than that, most of the markets have been neutral. Of course, oil also went up by 3.2%. Going to be pretty volatile, I think. While we have seen oil prices go up by 3.2%, we are also reading that OPEC plus countries are going to increase production, just because some countries like Iran have not been towing the line and controlling production. All the other countries are also going to ramp up production. So you are going to see more oil. Okay. Long-term trends, if you're tracking, I have been reading that the US shale gas production may have reached a peak, and it's going to be far more sensitive to costs going forward. Let's see how all that plays out. That's all for the week, folks. Thank you.